This is the current federal tax developments for the week of December the 2nd, 2019. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. This week we're going to look at a few developments here in this week following Thanksgiving. And I am holding one back for next week, couple of reasons. First thing is I'm going to be on the road a bit, so I've got to remember how much time I have to write everything up for next week. The other part is it came out very late, and it's actually going to be quite involved. So we'll talk some about it next week. We'll talk about the partnership audit rules and what the IRS released there. Give you a little bit of description in that area. And then, of course, finally, we just don't know how much they're going to be releasing just coming back from the holidays. So I'm betting that we may not have a huge number of things to talk about next week. There certainly weren't a huge number of private letter rulings released this week that we'd be looking at normally that would come out and be published in the publications for next week. So we'll see how much comes out. Now, because I say that, we'll get something like the Opportunity Zone regs or something, even though we haven't seen OIRA, as I recall, do anything with them yet. We'll see that come up. But, hey, that sometimes happens. I do have a couple of online broadcasts that are coming up available to you throughout the country. Your state societies, many state societies offer these through their own system, and you certainly check there for your discounts and other benefits. On December the 12th, I'll be doing a full day on partnership taxation advanced issues. That will run beginning, there are two different start times, and most times it'll depend on your state society as to which one of the two they offer you. Some offer both, but depends on the part of the country you're in mainly. One will start at 6 a.m. Pacific Standard Time, the other at 8 a.m. And again, you check your state society, sign up for that. We'll see what's there. Again, there are two updates, and obviously it's a recorded session, but we will be giving you a chance to ask questions, and we'll be answering them back via chat mechanisms or email, depending upon how detailed the question is and how many other things happen. But, you can check there. Also on December the 20th, going to have a full day on multi-state taxation of businesses. Basically the Wayfair decision and the like, and where we sit there with what's been happening. And that'll also be at 6 a.m. Pacific, 8 a.m. Pacific time. Again, check your state societies to see if they're offering these Cal CPA sessions. You can also sign up for them through Cal CPA's own website. So check and make sure you look for those. Let's start out with our first issue this week. This is the third time we have visited the idea and the problem of pyrrhotite in concrete in Connecticut. We started this a couple of years ago. If you remember, when this first came out, the IRS issued a special revenue ruling. For those who are not aware, this is something that should not be in your concrete for your foundation, because it turns out that if it is, especially in Connecticut and certain conditions with interactions with the soil, your concrete in a very, in a not long time period, certainly not long time period for something you want to be foundation of your house, begins to kind of crumble away. And if you go looking for this on YouTube, you'll actually find some documentaries or some stories have been published by the AP and the like, video stories. And it's kind of shocking what happens to the foundation when it starts crumbling away based on this damage. So we have this problem, bad concrete got in the system for certain houses built in Connecticut, and we have this major league problem. The IRS issued a ruling at first to simplify claiming the loss. Then, of course, the Congress came back in and with the Tax Cuts and Jobs Act, took away the ability to claim casualty losses that were not caused by a natural disaster. This is not a natural disaster. So the IRS put a special rule in for the pyrrhotite victims who may not have had everything completed by the end of 17. And now we're going to the third case of this. This is another follow-up. More things are happening in this area. At this one, though, it's just a little different. This is payments that were made by the Connecticut Foundation Solutions Indemnity Company, Inc. They made payments to victims of this problem, certain victims, to reimburse them for the expenses of repairing their foundations. So, insurance company issues that payment to you to fix a problem you have with your property. Now, there was a little confusion, and so the insurance company decided to issue Form 1099s on these two individuals that received these payments. That caused the obvious problem. The people receiving the payment said, wait a minute, why am I having to pay tax on this payment to just reimburse me for the damage to my foundation? And the reality is that, yeah, the answer is you probably don't have to pay tax on this unless you had previously claimed a deduction. But as I said, the insurance company being unaware of whether or not a 1099 was required, they issued these 1099s, and obviously this became a big deal. As you might guess, this whole thing's been a big deal, but this became a big deal in Connecticut, so we started looking at how to fix this problem. So a letter was written by members of the Connecticut congressional delegation to Commissioner Charles Reddick of the IRS asking, for a little bit of clarification on this. First thing is, should 1099s be issued? And secondly, well, do people pay tax on this? How does this all work? So the commissioner, in his letter, reminded us that the IRS had issued two safe harbors, IRS Revenue Procedure 2017-14 and 2017-16. Those are the two we previously discussed, that gave safe harbors for claiming losses on damage based on pyrrhotite. If you had paid for this stuff, paid for the fix, and you'd incurred these damages, you have this big loss from the pyrrhotite, the IRS had said that we'll allow you to claim the deduction. There was a special relief provision that allowed you to claim the deduction even if everything really wasn't done by the end of 17. And he said, that was in there, and we have this issue. If you had, in fact, claimed a loss in a prior year, let's say you claimed the loss in 17 because you incurred the expenses, then in 18 you receive this repayment. Well, the commissioner notes under Section 111 of the Internal Revenue Code, a section we often look at for income tax issues, for income tax refunds, state income tax issues, and we had a long discussion on that earlier in the year. We talked about the issue of state income tax refunds and the Tax Cuts and Jobs Act. And as you may remember from that particular ruling, we had noted there that, in fact, as long as there was no real tax reduction, if we took away what you'd received as a refund, you didn't have to pay tax on the tax refund you receive, even if you did claim state income taxes on Schedule A for 2018. Now we come back, it's the same concept here. If I had claimed a loss from the pyrrhotite damage back in 2017, and then suddenly this money comes in 18, then yes, under Section 111, in 2018, I would be required to pick up that income. However, the insurance company can't know if I did or didn't claim a deduction on my prior year's tax return. So while generally for payments made in the course of business that would be income, there's a requirement to issue that 1099 to the individual. The commissioner notes that the insurance company has no way of knowing if this is taxable income to the individual receiving the payment. As such, the commissioner said there is no need for them to be issuing the forms 1099 for these payments. That will keep them from dropping into people's mailboxes and presumably keep people from worrying about having to pay tax on this and, all the standard issues that would roll out of this. So again, I don't know if this is the last time we're visiting the pyrrhotite issue or if more is going to come up as we go down the line, but this at least got us the latest issue. We solved this problem. No 1099 should be issued, presumably for next year, for 28 for payments in 19, and but you still have to worry about if you receive a payment and you had previously claimed a loss, then you've got to worry about picking up that amount, any benefit that you got from the loss deduction in the prior years as income on the 2019 return if you received the payment this year. Next up, we have a case, and this is a rare case where a horse business wins on a hobby loss case. This is the case of Den Benston versus Commissioner. By the way, that's the gentleman's last name. His first name is not Den. So just to cover that up, usually I just put the last names up, and I realize some people may think this is giving both. No, that's the last name. It's a Tax Court Memorandum Decision 2019-154, and this was issued on November the 25th of 2019. And what happens in this case is we have a taxpayer. He had been successful in a seed business in South Dakota. He had been in charge of, separating out seeds, clearing things out, getting weeds out of there, separating them into the right categories, the right type of seed, and selling it to various parties. So he'd been successful doing that. He had also been, kind of on the side, been involved in the issues of shows that involved what's called essentially the cutting horse competitions. No, we're not cutting horses. We had that come up on Twitter with one response. No, this is not a business of cutting horses. What this is, a cutting horse, for those who don't know what the idea is, it's the idea of horses that are trained to basically separate one, basically steer from the herd. They tend to want to go back to the herd. You're going to separate one out. It may have been for branding or other purposes. We need to have this particular steer separated from the herd. And for that purpose, that's the job. These horses are trained for that, and there actually are competitions in this area. And Mr. Den Benston was actually a champion in this area and knew a lot about the whole cutting horse area. So when he kind of got ready to retire and shut down his business, he sold the business to his son. And he basically started up and invested in a cutting horse business that was not just his competition side of the business, but was also breeding and other parts that were very, very involved. He got a lot of money into this thing, and he got ready to get running. He had been successful. He was breeding horses. He had a plan to have this thing make money. But plans sometimes go awry. In this case, the problem wasn't the cutting horse business. The problem was his son didn't make a go of the seed business. And so his son only made 3 installment payments on the sale. He had sold the business to his son. His son was paying him on the installment basis. And basically, he only got 3 payments from his son. And then the son kind of fell apart. So he eventually stepped back in and tried to pick up the pieces of what had been a business you can kind of suspect after a couple of years had been run down quite a bit. If you've ever had that situation where a client sold a business and then later ends up trying to take it back, you can recognize that this is going to be a bit of a mess, that there's going to be a lot of issues to be dealt with. So Mr. Den Benston stepped back in. He began starting a seed business. The seed business initially took on losses, but eventually it started making income. Now, as part of that, he ended up realizing that despite all these great plans he had for the cutting horse business, that he really had to start getting away or scale back that business. So he started selling off certain assets, limiting things. He couldn't do as much in the process as he had wanted to do. And so he greatly scaled back the business. Now, the catch was nowhere in the history of his cutting horse business from before he sold the seed company, during the time he had the seed company in the hands of his son, which was only for a couple of years, and then to the time he got back the seed company and now he's scaling it down, Mr. Den Benston had never made money with the cutting horse business. The IRS decided that, well, wait, this is a hobby loss. Look, he's got income from the seed business. He's offsetting it with this cutting horse competition. The cutting horse competition has never made money. He's been doing it for a long time. And, we just think it's a hobby loss. We're going to disallow it. Well, the taxpayer didn't agree with that view, so we end up in tax court. And the court found in this case, they said, look, the actual facts of this situation suggest that there's a good explanation for the losses. By that they mean, they took a look at his initial structure. He sold off the seed business. He had just won major competitions. He had a reputation in the area, and he started investing and hiring people and taking the steps based on a plan. He didn't put in writing, but he had a clear plan of how to be profitable and had various areas that, he wasn't just putting all of his eggs in one basket and simply betting on like a breeding operation or a show operation. He had a lot of things he was going to do. He was going to make him very big into the cutting horse industry. And he had the backup, to make it apparently that he could make this work potentially. Well, the problem is before he actually had time to let all this come to fruition, he had to step back in and try to recover the seed business. And that took him away from it. And when that happened, he realized he couldn't do the cutting horse business in detail anymore. So he began scaling back the business. But because of all the money he put in and because of all the work and because of the issues with scaling back, he had losses in all those years. And the court also looked at a couple of key factors that in these cases tend to drive hobby loss decisions. One key problem we have often, and this with horse businesses tend to 99 times out of 100 be our big problem. It turns out that the person in question derives a lot of pleasure from just riding horses. And what the person ends up doing a lot is only riding horses, right? Riding horses, maybe they only do shows. They've done it. They participated in as a recreational activity for years, and they just love doing it. And it's clear they would keep doing it regardless of whether it made money or not. That looks like a hobby. In this case, the court says, well, clearly he had been involved with horses for years, and yes, he enjoys being around horses. But they said, look, he didn't just do the stuff that you liked. They noted he was getting up there in years, right? Well, up there, start looking at that. I got to watch what I say these days, because up there in years is it, when he started doing it, he was in his late 50s. And when we finished this up, he was about 64, 65. So basically, he's trying to do it the same point I was at. I'm basically at here when he did the original transition. And as he said, and as I could tell you, it's not going to be nearly as enjoyable doing those things. I mean, you just don't recover as quickly from things. The aches and pains get to you. You don't have as much get up and go, shall we say, to be doing this kind of hard work day in and day out that's physically demanding. He was doing that. He was involved in the breeding operation. He was involved in all the nasty sides of this, and I should say, by the way, the breeding operation, I say, can be dangerous in this case. We're talking about a horse breeding operation. There are dangers involved. Those are big animals that, if they start needing to be under control, they can be a major problem when you end up having to work with that. And we have the basic problem that, there just was a lot of work going in. He wasn't just coming down and riding horses and not worrying about whether or not he made any money. They said, so, it wasn't just a pleasure operation. And the other issue we tend to get into quite often is, was it just something that it didn't matter if it ever made money? That you were financially in a position where it could keep losing money forever, and you just really don't care. So, he liked his reputation in the horse breeding business, let's say, or in the cutting horse business, and he just wanted to, keep that reputation up, so he kept working here. And the fact it lost money was no big deal because he was making more than enough in the seed business, that there he would go. He didn't mind having it offset. And the court said that was clearly not the case here. They said, yes, he made money at the end from the seed business, and yes, was offset by this. But they said financially, he's not in a position, if you look at his overall financial condition, to be able to just continuously have losses year after year after year after year and not worry about the fact he's not making any money. In this case, the taxpayer, needed to actually make money. So at the end of the day, they said, hey, fine, there is no problem here. We're okay. These losses are fine. But the taxpayer did lose on one issue. And the issue the taxpayer lost on, though, was trying to claim net operating losses from prior years. And here's where the hitch comes. Like a lot of other cases we've discussed here, you have to remember, to prove a net operating loss, I have to be able to show that, in essence, nothing would have reduced the amount coming into the current year. So let's say I have a net operating loss in my 2019 return that arose from a loss that took place back in 2010. Now I've got to establish a couple of things. One thing I have to be able to establish even today for my 2019 return is the amount of loss I had back in 2010. It is not good enough that I filed my 2010 return. It is not good enough that the IRS never challenged the 2010 return. That does not establish the 2010 return was correct. Rather, what it does is simply I filed a return. The catch for 19 is the statute of limitations. This is misunderstood by a lot of people. I hear this given wrong quite often. The statute of limitation, it's important. And, I know many of you understand this distinction, but if you've not heard about this, when you've not gone this route, it's a major problem because people just say, oh, there's a 3-year statute. The statute is on the IRS being able to assess tax against you for that year and on you being able to file a claim for refund for that year. We're doing neither with 2010 right now. If we're doing it that 2010 NOL coming into 19. What we are doing is 2019 is the year where we're going to actually pay less tax because we're claiming this NOL. So we have to justify the 2019 return every deduction that goes to reduce the tax, even though a chunk of those deductions were incurred in 2010. And here's the catch. I not only need to be able to justify the 2010 loss, I've got to also be able to prove that we didn't lose that loss in the interim year. So I really need to be able to defend the 2011, 12, 13, 14, 15, 16, 17, and 18 returns, that they didn't have underreported income that could have absorbed that loss. I've got to be able to defend every one of those returns. The problem in this case was the taxpayer in this case was trying to claim net operating losses from 2003 and 2005, but all he had to back them up or the tax returns originally filed. That's merely the taxpayer's assertion that he had a loss. That blatant assertion that I had a loss in the prior years is nowhere near good enough to make this work. You have to understand, you've got to be able to defend all carryover items. The big problem that runs us into is clients who come in and say, especially the ones who love to say, how long do I have to keep my records? You have to keep the records for as long as they might be relevant on a later return. If you have a client with carryovers, and that would include, passive activity carryovers, so that would include capital loss carryovers, so that would include net operating losses, you need to be able to defend that original loss claimed back whatever year it was, and you got to be able to defend that it was never properly absorbed in the interim periods. If you can't defend all of that, then you can face a total disallowance in the year under exam. The service has every right to ask you for backup data from those earlier years. And that's what makes it very difficult to answer that question that clients always want answered is how many years do I need to keep my stuff? Well, if you have carryovers, that can be a long time. You need to keep the records to back up the entire return because, again, the IRS is not prohibited from questioning deductions or amounts of income reported in prior years. They only cannot go for tax specifically from that year. But we're not attacking that year. We're attacking the year that, in this case, was under exam, that was totally open on the tax side. And what happens in this case, the court essentially says, well, hey, guy, we really can't just take your word for the NOL. You got to have some evidence to back it up. The lack of evidence, means that we're going to disallow the entire net operating losses. Now, the good news was the court did not impose a penalty on him because they found he had reasonably relied on his CPA of 30 years. And we didn't hear a whole lot about how that worked, but I've got to assume that he had relied on that CPA, and that CPA may have given him even advice about records to be kept and the like and things along that line. Doesn't change the tax result, but did change the penalty result. Make sure you tell your clients very carefully. If they have carryovers, they need to have records for every year that could impact the carryover. And by the way, for a net operating loss, when we have carry back options, you have to be able to prove that, for instance, with an NOL, if we elected to carry forward, you got to have the election to carry forward. And if we did elect to carry forward, I don't just need the 2010 return now, I also need backups for the 8 and the 9 return because those 2 years could have absorbed the loss. So I have to have those backward years. So then it's looking all the way back to 2008 are my records for a carryback issue for the net operating loss. Yeah, messy, but it's something to be aware of. And as I say, be careful because clients always want you to answer that question of how many years do I have to keep my data? How long do I have to keep this stuff around? And it's not as simple a question to answer as the clients may hope it is. And that's something you got to be very, very careful of. Finally, we have Revenue Procedure 2019-48, issued on November the 26th. And this is the IRS updating the per diem rules for travel. And what's really happening here is the IRS is simply coming back and doing the same thing they did on the rules for auto mileage a couple weeks ago. We're getting them updated for the Tax Cuts and Jobs Act changes. So we're updating old Revenue Procedure 2011-47 to deal with those law changes. And basically, it's not changing most things here. There is one subtle change, and it's just a change internally for the federal government to make it work better. But otherwise, we're just doing what you probably figured out you should have done last year, given the TCJA changes. But they feel they need to rewrite these because the old Revenue Proc 2011-47 spent a lot of time talking about claiming this deduction for like Form 2106 for employee business expenses that were claimed as miscellaneous itemized deductions. As we all know right now, you can't claim those deductions on the returns anymore. We are in a suspension period. That's how it's technically raised under Section 7G. We're in a suspension period where those deductions are not allowed at this point. Will the suspension period be reversed? We don't know, but in the interim, you can't claim those deductions. So employees cannot put this on 2106, goes on Schedule A and claims the deductions. So this basically moves to remove that kind of discussion. Does not talk anymore about those areas about where you could claim it. You can still be reimbursed And, if you meet the requirements for the per diem, and it talks, again, this is a full replacement, 2011-47. So you can go to 2019-48 for the full rules on how per diem systems have to work. And you can still be reimbursed. I can reimburse my employees under these travel per diems. That also made that clear because some people were a little bit concerned that, wait, if the employee can't deduct it anymore at all, can we really still reimburse it? And they say, yeah, because Section 62 specifically talks about being able to have an accountable reimbursement plan. So we're still okay to reimburse at a standard per diem rate. Remember, the standard per diem rate is a rate assigned either using the high-low method or by using the published amounts for the area the employee goes to. You can reimburse their hotel and meals and incidentals. You can reimburse the meals and incidentals, or you could just reimburse incidentals using the standard rate. You cannot just reimburse hotel using the standard rate. That is one quirk you got to remember. You can do the incidentals. Usually I see the meals and incidentals is what's being reimbursed under the per diem plan. And that's the standard. I can't recall ever having seen a client use the hotel version where they did all three, but you do have the all three option. So we can still be reimbursed under the programs. Now, they do remind us that some people can still claim some deductions above the line, some employees. And the ones they remind us of will be certain performing artist expenses can go above the line. Certain expenses of state and local officials can be above the line. Certain expenses of elementary and secondary school teachers, that's a $250 limitation. That's probably not going to be much, but maybe, you got a per diem. That's the only thing they had. I don't know. They have, so you can claim that there for that $250. And reserve components of the Armed Forces of the United States, people in that can also be above the line, but those are limited above the line employee business deductions that we're allowed to get. Otherwise, we're just kind of out of luck, right? So that's where we get on that particular list. And the one change they did change the definition of incidental expenses to conform with the meaning found in the Federal Travel Regulations 41 CFR 301-3.1. And what that means for the moment is incidental expenses are defined as being fees and tips given to porters, baggage carriers, bellhops, and hotel staff, and staff on ships. That's what your incidentals are. And again, that's covered by this. So remember, if we're doing meals and incidentals, you don't reimburse tips because tips are part of the incidentals that are presumed to be being reimbursed by the per diem payment. Now, again, you don't have to use per diem. You can reimburse actual expenses. What I've found as a practical matter, though, to be totally honest, is that if you reimburse employees' actual expenses, they eat really, really well, right? You're going to go and spend as much as you think you can get away with your meals. And if you're reimbursing per diem, they tend to find the dollar menus everywhere. Now, you have to understand the incentive there. If you're talking about salespeople that you'd like to basically impress people, then you probably want to be considering doing the full-blown reimbursement. If you're talking about just your average staff going out for training, or as I should say, CPE instructors, that's known to happen to us too, then probably the per diem is a better rule because the catch is if you do actual reimbursement, they're going to eat, they're going to basically charge through whatever they can. If you do the per diem, then you know the amount. You're not going to get whatever the fanciest restaurant in town is not going to become the thing listed on the expense report. So, we'll just kind of take it from that standpoint. So again, we have the brand new revenue procedure 2019-48. If you have been looking at 2011-47, where you've looked at the per diem rules before, you're just going to substitute this in. Again, not significant changes except for pulling out the 2% discussion. Well, again, don't get left behind. We are now coming down to the end of our 2019 fall CPE season. In fact, we'll be heading, I'll call it fall all the way because by the time we get officially to winter, we're pretty much done with the CP season, except for those who's going to take something in January. Yeah, winter is basically January CPE season. I am going to be doing stuff there. Sign up for your courses. We've got some coming up. I do have a few happening. I am doing, of all things, a accounting and auditing version this week, disclosure, the key to financial statements. I'm doing that in Phoenix on Friday. Yep, I'm doing ANA, but you guys are interested in tax, so we're going to talk more about the tax ones coming up. On December the 12th, I'll be doing, for the Connecticut Society of CPAs, I'll be doing one for talking about assisting survivors of the decedent's estate. That will be in Connecticut. It'll also be taped for Cal CPA. So we will have that. That'll be rebroadcast later. But if you're in basically the Hartford area in Connecticut or anywhere nearby, you can drive on over, because I'm going to be spending some time bouncing around the area. I'm going to be bouncing between two locations in Connecticut, and I'll be in Westchester County doing some work during not this week, but next week. So on the 12th, you can see me there. I'll come back then on the 16th, and I'm going to be doing two webinars for Arizona. Or I should say, two live session webinars for Arizona, Arizona Ethics and Arizona Taxes. These, as you might guess, are not, those are not ones we're going to be taping for rebroadcast for Cal CPA, because probably the rest of the country doesn't care too much about those. But if you do care about those, you need Arizona Ethics because you're licensed in Arizona. You can sign up for that. It is available as a webinar, so you don't have to be in Arizona to take those. If you have some reason to file a lot of Arizona tax returns, this is income tax only in this session, so we also have that side. On the 17th, I'll be doing the current federal tax developments update. That'll be webcast, 8-hour webcast, and and the live session at the Phoenix office. That will also be taped for rebroadcast. I believe they're going to rebroadcast that in January for Cal CPA. And I'll try and work up any sort of notes about things that change in the interim, because who knows what's all going to happen. But we'll discuss what's happened, and the main goal is discussing things that have happened since we had the 199 Cap A final regulations. I kind of figured that as a cutoff point. Up to then was last year's update, right? Because we all had to deal with that 199 Cap A final regulations rules that came out in January during last tax season. But there's been a lot happened since then. We'll be discussing that in Phoenix on December 17th. You can sign up for those courses at the Arizona Society of CPA's website. This has been the Current Federal Tax Developments again for the week of December the 2nd, coming back from Thanksgiving, entering into December. You can catch up with our news as we give you updates on currentfederaltaxdevelopments.com site. I'll be writing things as they happen this week at that site. You can also send questions and comments to me, Ed Zollers at currentfederaltaxdevelopments.com. If you have any questions or issues, that's the best email to use to get issues to me, because if you go to my main office email address, I do prioritize I try to prioritize clients on that address, and I'm not necessarily in the mode. And as I say in courses, we all have that list of things we're going to do when we get around to it. If it goes to that email address, it tends to go into the, well, I'll do this when we get around to it. And we all know that when we get around to it list goes way, way, way on the back burner. It'll be a couple of years, we'll get there. But you go to the currentfederaltaxdevelopments.com site. That's what I'm into, thinking CPE, answering CPE questions. That's the best place to find it. You can also follow me on Twitter at Ed Zollers. I follow discussions on the State Society websites for Arizona, Minnesota, and New Jersey. So you can do that. The Connect sites there. I also follow the Cal CPA discussion group, Tax Talk, and on Reddit at /r/TaxPros. On Reddit, if you go to that site, you'll see we'll have some discussion on tax issues there. Well, we're in the last month of 2019, the last month of this decade. So we're going to finish out the tax decade here shortly. So we'll talk to you about what's going on in the next few weeks as we close out this decade, enter into the 20s. So we'll enter into that segment. So we'll see if the 20s in this time roar or not, as they did back in the last century. But we'll be talking to you about anything that happens during all those times here on Current Federal Tax Developments.